Hey guys, it's Danny with Pink, and today I wanted to respond to a couple of messages that I had. Some of you guys I've been asking for y'all to send in some topics, and I was gonna make videos, points of conversation. I was gonna layer in answers to those questions and topics that you might have, and try to lay it out in a way that was educational and helpful. So the first one that I have today actually comes from our affiliate of ours up toward Hartford. His name's Scott. And Scott texted me in and said, this is one that a lot of people talk about. Not only our Pink affiliates, but a lot of people in the industry as a whole. You see this in a lot of Facebook groups. You see this in a lot of education circles. Y'all familiar with the 70% rule? It's not our steadfast rule in making cash purchases, but it is my quick and dirty kind of way to break down deals to see if there is an opportunity for a deal there or not. So Scott texted in and said, is there an alternative to the 70% rule? That's a big question because obviously in a competitive market, the 70% rule makes your available properties pretty thin. Now, I'm going to talk about factors that go into that. I'm going to talk about differences in strategy that you can use to overcome that. But a big part of this is, can I use that 70% rule? Is that 70% rule the cut and dry rule? Are we not getting outside of that? He goes on to write that this rule brings him to embarrassing offers, which we quasi joke about. Like if your first offer didn't embarrass you, then you didn't go low enough. But I understand where there's sometimes where you know that it's an act in futility. Not so much that the offer is embarrassing, but it doesn't have a chance. So you're kind of going through the motions without getting any fruits for your labor. He also says, I know we can go 80 to 85%, but then I'm afraid that I'm chasing a deal that I may regret. Again, that's another big topic of discussion because, you don't want to chase that property that doesn't produce the yield that you're looking for at the end of the investment, right? At the end of the day, when you're buying for cash, you're laying you or somebody else's cash on the table. In our case, it's always going to be somebody else's cash for the most part. You're laying that on the table. So there is risk involved, right? Now, we typically don't, we don't get into deals to lose money. We get into deals to make money. It's more about how much money you're going to make, not what money you're going to lose. So it's about finding the right deals. And you're right. If you get, Scott is right in his concern. If you get into that 85% range in today's market, in your specific market conditions, which can be very different from Scott's or mine or somebody else's, like I'm in Jacksonville, Florida, where we do have a large volume market, a lot of turnover transaction, a lot of availability, obviously heavy investment culture here, a lot of real estate investors. So the off market is getting very saturated also. However, you can still go on MLS and find deals that make sense. I mean, you can get within contact circles and find off market deals that make plenty of sense, that fall closer to that 70% rule to make you comfortable. Now, I'll tell you that a lot of the properties that we purchase, the 70% rule again is a guide to know if it's a decent purchase or not. It's not a steadfast rule. I would be willing to bet that the last 5 flips that we did when broken down, we didn't buy them exactly at the 70%. We still made money on all those deals. And that's really what you have to look at, right? So when I look at the 70% rule, it's a down and dirty formula to break down if a deal's even in orbit, right? And that 70% rule kind of explained would be, it gives you the maximum allowable offer that you can make on a property. So you have your purchase price, which basically you run comps, come up with an ARV that you're confident in. I would tell you right now more than ever, your comps, you got to tighten the time frames on them because we have an ever-changing market, right? I'd love if you had comps within 3 to 6 months as opposed to 6 months to a year before you're setting your after repair value, which is ARV. So that's the top of the market. That's what you feel that home would bring if it was fully fixed up and it looked identical to the properties that you're comping it to in finish, work quality, design. Like that's the standard you're using to price out your investment, right? I only stress on that because you can't use Taj Mahal comps and then do a rental rehab and think that you're going to get Taj Mahal prices. you will lose in those scenarios. That's how investors get in trouble. That's how they get bitten, right? So be cognizant of that when you're comping the houses and you're building out this investment in your mind. Okay, now I've got a cost of rehab that gets it to that level. Otherwise, I'm losing money, leaving money on the table, right? And the numbers won't work out in reality with what they looked like when you put them together on paper. So you comp the property, you get your ARV. Now you multiply your ARV by 70%. Then you have to subtract your cost of rehab, including a cushion for overages for the Murphy factor. Something goes wrong in a rehab that you didn't think about, right? Holding costs of the property typically are not thought of, right? That little overage, that little Murphy fund kind of covers all those things. Lawn maintenance, all the stuff that comes with having a flip property as you go through the process of turning that property over to sell it. So now you have your 70% number minus your total costs of rehab. That leaves you with your maximum allowable offer in air quotes, right? Now, what you'll find and what Scott found while he's driving that text message into me was that leaves me in a place where I don't think I can compete with making offers. And that throws up a couple of other topics to talk through. Obviously, if you run those numbers and you're looking at a profit split between what you paid and what you can sell for after all your expenses, and you're making more than $30,000, $40,000, $50,000, you're on the right track. That's a great flip. If you're going to put money on the table, $40,000 in a flip, $30,000 in a flip, those should kind of be your target profits that you're looking at. If that 70% is leaving you with a lot more margin than that, then you can kind of back that offer into a number that fits the profit model that makes you comfortable. And you would run every one of these purchases through us, and we would kind of give our okay on whatever you're going to lay cash out to buy. But you got to know that once you've got that 7% number, now you need to look at your profit margin in the deal and blur the line in between the two until you can get to an offer that makes sense. If you can't, and the offer doesn't make sense, then you can't chase that deal, right? Like if there's $20,000 on a flip, I can tell you that that's really thin. You've got cost of money, you got labor overages, you've got, anything that can happen that can put that at risk. $25,000 can get eaten up really quick in a flip deal. So that's not a ton of cushion for your profit. So if you get into a range where it's looking like on paper you're only going to make $20,000 on a deal, you're now chasing that deal. That deal is not going to be a smart investment for your money. You can do other things with that same money, make a greater return on it. And we're going to talk a little bit about that also. But that's kind of when you step back from the 70% rule and you're looking at, okay, is this a steadfast rule? Is it a rule of thumb? It's a quick equation to use to get in the orbit, right? To be thinking about what the profit could be and then how I can back my offer into that to where it makes sense, right? So I think if you use that 7% rule and you're it's the law, then you're not going to make many offers that go far, right? You're going to have a lot of acts of futility, right, that don't get you the result that you're looking for. However, quick and dirty rule lets you know if you're in the orbit, lets you know if you're close, and you can play with the numbers from there. And then I highly suggest that before you write any offers, you send them into us, that we're looking at the same thing and we can kind of give our blessing on if it looks like a good deal or not. Another thing that comes up with that a lot is knowing the construction costs. So you do have to build out your dream team. You got to know agents in the game. You've got to know other investors in the game. And also importantly, you got to have good contractors who are in the game, in the marketplace, can give you, down and dirty estimates that come in pretty close. Another way you can get in trouble is, when you're running that equation, you think it's going to cost $30,000 in construction, but then your contractor comes in and doubles that on you because, they didn't put the pen to the paper. Or you just went in and estimated and you overshot your runway on that also. That's going to get you in trouble. If you estimate $30,000 and you spend $40,000, okay, $10,000 can be absorbed in a flip. It wouldn't even be out of bounds. That would be fairly normal to have that happen. It can also go the other way. You can come in $10,000 less. That's more rare than going over, it seems, in today's market. But If you're $30,000 over, that's gonna, you did all this work kind of for nothing. That was your profit that's getting eaten up. So the construction cost is a big deal. It's got to be nailed down. You've got to have people you can trust. And again, those are things you can send our way too. Videos and photos of the properties. We can give you kind of what we think it's going to cost in rehab, and we can compare notes even with your local contractor. And again, before you get into the project, all these things have to be very clear. You need a scope of work from your contractor with a draw schedule that lays out the budget. And not only the budget, but they need to see the properties that are the ARV so they know the level of work that has to happen, because they have to commit to that at the budget they give you. Another place where people get in trouble with contractors is they give them the list of what they want done. The contractor gives a price. They negotiate them down to a cheaper price, and then they get cheaper grade work because it has to come from somewhere, right? So work with your contractor diligently to show them what that property needs to look like, what the finishes need to be, the level it needs to be at to sell to get that ARV price. Or again, you're going to leave money on the table. You're going to lose money in that deal. You're not going to want to do a lot more of them after a couple of those. So the 70% rule, there's a couple of very important things. The variables are the ARV, being confident in your comping ability, the value of the property, the craftsmanship, I'll call it, of the contractor, mirroring that ARV property, and then clarity on the budget and the estimate so that you can really work your numbers to make that offer confidently. And without doing a ton of flips, you just won't have that firm grasp on exactly what's going to cost. So that's why you can bounce that stuff off of us. Bring those to us all the time, and pull your contractor in as well. We're happy to talk with them, kind of work through that. And then again, you can back into that number on the backside of your 70% equation. And you can find a comfortable spot where you're making an offer that a seller will accept and there's still profit in the deal. And it's a good investment of the money and the time. It's good for your investor. It's good for you. Contractors getting work, which is good for them. Sellers getting a price, solving a problem for the seller. There's a reason they need a cash offer typically. So that's kind of the way that I back into it. Scott goes on to ask about the rents. So a lot of people in this business, when you're looking at rentals, they use the 1% rule, 2% rule. If you guys haven't heard of that, basically the rent needs to be 1% of the purchase price to be comfortable. That's all fine and dandy when rates are at 3.5%, 4.5%, even 5%. Today's rates, that really skews that number, right? And it skews your ability to cash flow on a rental also, right? So you got to think of that. If you're going to go get bank money on a rental property and it's at 7.5%, that same rental property that would have cash flowed you $400 is not cash flowing you anything in today's rates, right? So everything kind of has to adjust. The real estate investment market is a big linchpin of it is bank money, obviously. Now, we can operate around bank money, but private money is more expensive than bank money, so you don't buy a rental to, park private money there. Cash flow numbers typically don't make sense on that. So at some point, you have to get bank money, typically with a rental portfolio. So that 1% rule is getting tough. Like, it's hard to find 1% rule properties that make sense. However, in a lot of markets, the rent has increased as the cost to be a landlord has increased. And debt service is a part of that cost of being a landlord, right? If I own a property and there's mortgage on it, taxes, insurance, I have escrows to pay, maybe I have HOAs, then I have upkeep. As all the inflation hits all of those things, it also drives the price up on rents. So sometimes that can even out, and you can still look at that 1% rule. But use a cash flow calculator when you're looking at a rental, and be studious with the variables that you're putting in to that calculator. I have one. If you guys don't have it already, you can comment on this video and we'll get you a copy of it. It's a very easy to use spreadsheet. But again, some of the same principles apply. You got to know how to comp a house. You got to know how to find rental comps, right? And your house has to look like what the other rentals that are commanding the money look like, right? Like, if there's a 1,500 square foot house that's getting $2,000 a month in rent, and it's got, marble countertops and updated stainless steel appliances and, LPV flooring throughout, and then you have a house that's got the old boxy white fridge and Formica countertops with laminate, linoleum flooring or something crazy, you're not gonna get the same $2,000 that the other house is getting. And you've done everything to that point based on getting that $2,000, and then you get it out there and you realize, well, I can only really get, dollar square foot. I can get $1,500 for it, but that's what it costs you every month. So you're not doing yourself any favors. You're not making any money there, right? So just as in the current economic climate that we're in for real estate, you have to really pay attention if you're going to flip a property. You got to pay attention to your buy and holds also. Anytime cash is going on the table, you have to be scientific with your numbers and your due diligence. And I will say there are just some markets and places that it just doesn't make sense as an investor right now. It might make sense for not your competition, but a home buyer, right? A big thing that we talk about a lot is who are you competing against when you're making cash offers, right? And right now in some markets, the general rules of economics are broken. There can be little supply and high demand and still not a lot of business going on, right? There can be, because of the lending, because the interest rates are so high. But also, that can sway both ways. That can stall the market. That can also make first-time home buyers just way outprice investors. What I mean by that is if you're in an area where you have low supply, that drives up the demand, and people still need housing. So that fixer-upper that before a first-time home buying couple wanted nothing to do with, now because of the landscape of the market, they have to get into those properties, and they're paying more for those properties. They're not using some 70% rule when they look at a deal like that. They're not looking at it like that. That's their home. So when they put money into it, it's sweat equity investment for where they live. It's not to turn a profit in a couple of years, right? So we can't really compete with that. Like I can't make an offer typically better than some first-time home buyer or just a home buyer in general who is the end user, because I need a discount so I can make profit. I need to buy at wholesale prices, quote unquote, so I have a profit in there to where they're a retail buyer. And we can't compete with that. So you have to change the venue, all right? A lot of times if you don't like the economics in your market, change your market. There's nothing that just boxes you into doing deals where you live. There's 50 states in these United States, and somewhere in there are some deals. We're finding them all over the country. Middle America, beautiful place to be investing. The Midwest, Western Pennsylvania, Central Pennsylvania, Ohio. Ohio's great. Missouri, fantastic opportunities. East Tennessee, some great opportunities. Kentucky, there's some great opportunities. I mean, there's deals everywhere if you just get in there and look. They might not be right in your specific backyard, but they're still out there, and it's so different in different markets. Your general rents and rates of return change based on markets so much because cost of real estate in certain markets just prices investors out of the area. And again, it goes more toward that retail side. So one of the things that I tell people to do is if you're not finding deals where you're looking, change where you're looking, right? Open the horizons up. You don't need to be hands-on to have income properties. Now I would prefer that you're hands-on if you're going to flip a property because you kind of need to be there. So if your market isn't giving you a ton of opportunity to flip properties, I would say you need to charge after that off-market lane a lot more. Like if you're looking to flip properties and your area is not just flooded on the MLS with a bunch of opportunities because of low supply, you need to start playing in the off-market world, meaning, you're going to have to think about off-market marketing, whether that's pay-per-click marketing, social media marketing, direct mail, or my favorite, a combination of all three, to find new deals, new opportunities that first-time home buyers and retail home buyers aren't finding. And then you might say, well, isn't that what the other investors in town are doing? It is, and you can piggyback off of their marketing. In a lot of markets, we find investors that wholesale is their business. They're finding the off-market deals. They're also finding would-be on-market deals that they don't know what to do with. And that's the door that you can crack open right there, because they don't know what to do with them. When you can find those people, I've got affiliate David Johnstone. He's got a deal in Jacksonville, of all places, through another investor. Very simple. Had a conversation with the investor. The investor didn't know what to do with it, didn't know how to execute a lease purchase. David steps in, partners with him, and, kind of off to the races on it. That can be done anywhere, and it's been done in markets time and time again through numerous affiliates all over the place. And you can execute that same strategy. You just got to be dedicated and disciplined to network with other investors, find investors with properties, find the problems, and then offer up solutions, because you have so many ways to do it kind of at your disposal. One other thing I wanted to talk about on this video was, if you're struggling to find rentals and you want rental style income, rental returns, here at PINK, we do have access to an off-market portfolio of properties that are performing assets, that give a strong double-digit return, very safe, extremely low loan to values, right in that 50% or way less than 50%. And these are opportunities that you as PINK affiliates can get direct access to that other people don't have access to. So if you're interested in a rate of return comparable to, or in a lot of times a lot better than having a rental, talk to us. Comment on the video, let me know, reach out to me and talk about it. We might be able to put that money to work and give you kind of the best of a rental, but you have no responsibility. All right, there's no responsibility. You don't have to play landlord. You don't have to pay property management. It's a very hands-off approach to investing in real estate portfolio that gives you all the benefits without any of the headaches, if that makes sense. So if that's something you're interested in, comment on this video, let me know. If you have questions about how I leverage the 70% rule, how you should be doing it better, how do you calculate cash flow on a rental, can I get access to the spreadsheet? Comment on the video, start a conversation, reach out to me, let me know. We'll get you all the information you need. We can have one-on-one conversations about direct, apples to apples comparisons happening in your market, in your backyard, problems that you're dealing with and going through specific to your attack to go find properties. But I wanted to break that down from my viewpoint, how I use the 70% rule, how we kind of play with the profit number on that, the important high notes for me when looking at purchasing a property for a cash flip or a rental, and then just share some other options that we have for you guys. So again, if you have more conversation that needs to be had about it, comment below and start the conversation. Get other affiliates involved in the conversation. We can look at specifics in your marketplace. We can break them down one-on-one, get you some clear marching orders and new strategies to find new deals, and hopefully get you on the path to making a bunch of money in real estate. So again, if you have questions about it, comments, hit it up below, or just reach out to us through the Facebook group. We're happy to help and looking forward to the next video.